Every day, hedge funds deploy armies of algorithms that analyze mountains of market data faster than any human could. Using machine learning, these systems detect subtle patterns, predict price movements, and execute trades in milliseconds, often before anyone even notices an opportunity. From scanning social media sentiment to processing economic reports in real time, machine learning gives hedge funds an edge that can turn small market inefficiencies into massive profits. For the average investor, it's a world of invisible forces shaping markets behind the scenes. Step inside the secretive realm where math, data, and artificial intelligence drive some of the biggest financial decisions on Earth. Machine learning has become one of the most powerful tools in modern finance, and hedge funds are leading the charge. By combining vast data sets with advanced algorithms, these firms aim to uncover patterns and signals that traditional analysis might miss. Unlike conventional trading strategies that rely heavily on human intuition or fixed rules, machine learning models continuously adapt, learning from new data to refine predictions and improve performance. Hedge funds use these technologies to analyze everything from historical price trends and macroeconomic indicators to real-time news feeds and social media sentiment. The goal is simple but ambitious: gain a measurable edge over the market. However, while machine learning offers speed, scalability, and precision, it also introduces complexity, model risk, and potential over-reliance on data. This article explores how hedge funds apply machine learning to trading, the types of models they deploy, the advantages they seek, and the risks that come with algorithm-driven strategies in highly competitive financial markets. Machine learning, or ML, is a subset of artificial intelligence that allows computers to learn from data and improve performance without explicit programming. In finance, ML is used to analyze complex data sets, detect patterns, and make predictions that would be impossible or extremely time-consuming for humans to identify. Unlike traditional models, which follow fixed rules, machine learning systems adapt over time, refining their algorithms as new information becomes available. In hedge funds, ML is applied to a variety of financial tasks. Predictive models can forecast stock prices, interest rates, or currency movements by identifying correlations in historical and real-time data. Natural language processing, another branch of ML, analyzes news articles, earnings reports, and even social media sentiment to gauge market mood or anticipate market-moving events. Unsupervised learning can detect hidden structures in massive datasets, helping funds uncover arbitrage opportunities or assess risk exposure more effectively. Machine learning's strength lies in its ability to handle high-dimensional, noisy data at speeds no human can match. This allows hedge funds to make faster, more informed trading decisions, optimize portfolios, and react to market events with unprecedented precision, giving them a competitive edge in highly efficient markets. Hedge funds don't just use off-the-shelf machine learning models. They carefully train algorithms to detect market patterns and generate profitable trading signals. Training begins with massive data sets, including historical price data, trading volumes, economic indicators, and alternative data sources, such as news articles, social media sentiment, and even satellite imagery. The goal is to teach the algorithm to recognize relationships and trends that might predict future market movements. Supervised learning is commonly used, where models are fed labeled data showing past market outcomes. The algorithm tests different strategies against this data, adjusting its parameters to minimize errors and improve predictive accuracy. Unsupervised learning allows algorithms to detect hidden patterns without predefined outcomes, uncovering clusters or anomalies that human analysts might miss. Reinforcement learning is increasingly applied, where algorithms simulate trading environments, experimenting with strategies and learning from simulated successes and failures. After training, models are rigorously backtested to ensure they perform under various market conditions. Even after deployment, algorithms continuously adapt, learning from new data to refine decisions in real time. This iterative training process gives hedge funds a dynamic edge, allowing them to exploit market inefficiencies faster and more precisely than human traders. Hedge funds use machine learning to predict market movements with precision and speed that human traders cannot match. At the core of these strategies are models designed to analyze vast amounts of historical and real-time data, including price trends, trading volumes, economic indicators, and even alternative data like social media sentiment or satellite imagery. By identifying patterns and correlations, these algorithms generate actionable insights for trading decisions. Supervised learning models are widely used for price prediction, where algorithms are trained on labeled datasets to forecast short-term and long-term asset movements. Unsupervised learning helps identify hidden structures, clusters, or anomalies in market data, uncovering opportunities such as arbitrage or mispriced securities. Reinforcement learning allows models to simulate trading environments, testing strategies and learning from simulated profits and losses to optimize performance in live markets. Other popular approaches include sentiment analysis, which scans news, earnings reports, and social media to anticipate market reactions, and factor modeling, which isolates variables that historically influence asset prices. By combining these strategies, hedge funds create a dynamic, adaptive system capable of responding instantly to market events. Machine learning transforms vast, complex data into predictive insights, giving hedge funds a significant edge in highly competitive and fast-moving financial markets. Machine learning gives hedge funds advantages that human traders simply cannot replicate. Algorithms can process massive datasets in real time, scanning thousands of securities, economic indicators, and alternative data sources simultaneously. Humans, limited by speed and cognitive capacity, cannot analyze such volumes or react in milliseconds to fleeting market opportunities. This speed advantage allows machine-driven systems to execute trades before patterns become apparent to human traders, capturing profits from tiny price inefficiencies that would otherwise go unnoticed. In addition to speed, machine learning models excel at detecting complex, non-linear relationships in data. Where humans might overlook subtle correlations or hidden trends, algorithms can uncover signals across multiple markets, asset classes, and timeframes. This capability enables sophisticated strategies such as statistical arbitrage, predictive modeling, and sentiment-based trading, which would be impractical for manual execution. Moreover, ML systems operate without emotion, removing human biases such as fear, greed, or overconfidence that often undermine trading decisions. Algorithms adhere strictly to predefined risk parameters, continuously optimizing strategies based on new data. By combining speed, data processing power, pattern recognition, and emotional neutrality, machine learning gives hedge funds a distinct edge, allowing them to outperform traditional human-driven trading in an increasingly competitive and complex market environment. The future of investing is increasingly intertwined with artificial intelligence and machine learning, and hedge funds are leading the charge. As computing power grows and datasets expand, AI-driven strategies will become more sophisticated, capable of analyzing global markets, alternative data, and real-time news with unprecedented speed and accuracy. This evolution promises to further reduce the time between identifying a market signal and executing a trade, making markets even more efficient and competitive. Beyond speed, future AI models will integrate advanced techniques such as deep learning and reinforcement learning, allowing algorithms to learn from past successes and failures and adapt autonomously to evolving market conditions. Predictive models will become more nuanced, incorporating economic indicators, geopolitical events, and investor sentiment to anticipate market shifts before they occur. However, the growth of AI in finance also introduces challenges. Over-reliance on automated strategies may increase systemic risk, while opaque black box models make transparency and regulatory oversight more difficult. Human oversight will remain critical to ensure ethical decision-making, risk management, and market stability. Ultimately, AI-driven investing is set to redefine the financial landscape. Hedge funds leveraging these technologies will continue to push the boundaries of speed, precision, and strategy, reshaping the skills and roles required for human participants in the markets of the future. Machine learning has fundamentally changed how hedge funds approach investing, giving them capabilities far beyond traditional human strategies. By analyzing massive data sets, detecting subtle patterns, and executing trades in milliseconds, AI-driven algorithms provide speed, precision, and adaptability that humans cannot match. Hedge funds use these tools for predictive modeling, sentiment analysis, statistical arbitrage, and dynamic risk management, turning complex data into actionable insights. The edge lies not just in speed, but in the ability to process high-dimensional, noisy data while remaining free from emotional bias. Algorithms continuously learn and adapt, refining strategies in response to market shifts. While this technology improves efficiency and potential returns, it also introduces new challenges, including model risk, system failures, and opacity that complicates oversight. Looking ahead, AI-driven investing will continue to evolve, making human oversight and strategic judgment essential. Hedge funds that master machine learning will dominate markets, while participants who fail to understand these systems risk being left behind in an increasingly automated financial world.